or we're feeling very optimistic about it. What are we afraid of today? Everything but Treasury bills, right? So everything except Treasury bills is undervalued. Now in the 90s, what were we very optimistic about? Everything, particularly technology stocks. I mean, people were buying stocks that weren't even real companies yet. They didn't have customers. But they were paying, hundreds of dollars a share for these stocks that were just kind of business plans. It's phenomenal. What was that based on? Was it based on fundamental economic analysis? It's based on optimism. So in any point in time, we think of some things as more safe. That's optimistic. We're optimistic about some things, and we're pessimistic about some things, right? Now, over time, these markets have something to do with, again, underlying cash flow and earnings. But in the short term, it has everything to do with whether we're feeling optimistic or pessimistic about that particular market. And what we think of as optimism, we might feel optimistic about real estate today, or we might feel optimistic about the stock market today, or we might feel optimistic about Treasury bills today. But whatever that is, that's the asset class that all the money is going to. And then eventually, what happens? So much money goes into that asset class. Right now, you can earn more money on the dividend yield in the S&P 500 than you can with the Treasury bill. I don't know, when is that the last time that happened, Andy? Do you remember? I mean, it's been, not in my lifetime, I don't think. I mean, it's been ages. Not in my investing lifetime.
Would you say that right now
you can earn more on the dividend yield of the S&P 500 than you can buying Treasury bills. So the dividend rate of the S&P is higher than if you bought an obligation of the U.S. government. So there's basically what we're saying is nobody wants to own stocks. Everybody wants to own treasuries because they feel that they're safe. Well, at some point, people are going to look at that. I can earn 1% on treasuries, or I can earn 2.5% if I buy stocks. What are you going to buy?
Depends on how afraid you are.
Depends on how afraid you are. Well, eventually, will people get less afraid? And might they decide that they want a little more return? So they're going to go over here and buy these stocks at 2.5% versus buying these bonds at 1%. And then people remember the most recent investment history. So as we get a little further away from this crisis that we've had, people will begin to look at this and say, well, maybe I should buy some of these things over here. And then what will happen? Well, eventually, more people will buy, and more people will buy into that market until we go from the fear side of the market to the optimism side of the market, and it becomes overpriced. So at any point, we're somewhere in that cycle with every asset class. And the good news is, for the most part, those are not always the same. Now, what happened last year was pretty unusual in that virtually every asset class outside of bonds went down. The long-term bonds even went down. It was only short-term bonds that didn't go down. So it was an unusual period. That usually what happens is when we have different asset classes, they're not all going down or all going up together. We call that correlation. If I'm doing this, my arms are correlated. You know, the synchronized swimmers, but if I'm doing this, I'm totally uncorrelated. Okay, so the idea is we want to own things that are working like this, right? We want some things in our portfolio to be going up and other things to be going down, and we can use that to make money. Use that knowledge. So what we're saying is we want to buy different asset classes. So what are some examples of those? Well, bonds are an asset class. Convertible securities, treasury bills, stocks, commodities, real estate, all are asset classes that one might want to consider buying. And they're not necessarily correlated. If I have a correlation of 1, that means I'm perfectly correlated. But if you look on this chart, if you look at large company stocks, I see you're up at the top, and look down here at treasury bills, minus 0.02. So treasury bills and large company stocks are not correlated. Intermediate government bonds are not really correlated. Small company stocks, Greg, you mentioned small company stocks, they're 0.79. So they're somewhat correlated to large company stocks, but not exactly. So what we want to do is we want to own assets that are not correlated so that when large company stocks are going up, maybe something else isn't going up. We want to own a variety of things so that we have assets that are going up and going down in our portfolio. And we're going to use that to our advantage using asset allocation. So do you all understand what I'm saying? That optimism and fear drive current markets. and asset classes, what people think of as safe, what they're optimistic about, changes, and that's what drives the short-term markets. And that's why we want to have some of everything, because we don't know what people are going to want to own tomorrow, and we don't want to try to guess because we know market timing doesn't work. So I know you can't read the numbers on this slide, and it's really not important that you read the numbers on this slide, but what is important that you read the slide. So let's look at it for a second. Just the colors. This slide works like this. This is the highest return, okay, up here, all these things. And this is the lowest return. And this is years. This is 1996, and this is 2007. And each one of these colors, this dark blue is an asset class, and this orange is an asset class. Each one of those colors represents an asset class. So if you were writing a narrative about where these boxes move on this chart, what would you say? They're all over the place. What happens when something's at the top? It ends up at the bottom at some point. Is there any pattern that you see? There's some things that stay in the middle. Value stocks kind of stay in the middle, but they still go up and down. The yellow looks a little more conservative, so those are large cap value stocks. They sort of stay more in the middle. Those are foreign stocks. Foreign stocks are much more volatile than U.S. stocks because why do you think that is?
The currency value.
The currency value. So when you're buying an international stock, you have the underlying investment of the stock, but you also have the currency value. We're buying it in U.S. dollars, but if it's a Chinese company, we have the change in the U.S. dollar that's happening at the same time. So you have two things that are making it volatile. So foreign stocks are more volatile. So one of the things we know is there's really no pattern. What's the highest return ends up at the bottom in a few years. Now, how do we use this information to help us make money? That's the real question, right? We use something called modern portfolio theory. In modern portfolio theory, some people who really like to do analysis went in and looked at the largest pension funds. That's how they developed this theory. They went into pension funds where there were billions of dollars because their theory was if you had billions of dollars, you could hire the very, very best investment advice, right? And if you could hire the very best investment advice, then we could look at their returns and figure out why it is that these funds made money. What were the components of the return? What was it that drove return in those portfolios? And what they found were asset allocation, market timing, and security selection were the primary drivers. Now, asset allocation is whether we have oranges, apples, and bananas. In other words, whether we have small cap stocks, foreign stocks, or commodities. That's what our asset class is. What do you think security selection is? Which company do I buy? Do I buy Procter & Gamble, General Electric, Microsoft, or some small startup? Just what do I buy? What specific security do I buy? What about market timing? What is that about? Yeah, do I buy today or do I get in and out of the market today? So of those three things, asset allocation, market timing, and security selection, based on what you hear on the news, what do you think is the biggest driver of return? Of those three things? Optimism? Timing? Market timing? Yeah. So somebody's always telling you whether to get in or get out, aren't they? Well, let's look. Here's the contributing factors to asset allocation. If you look at this slide, this asset allocation policy right down here drives 91.5% of portfolio performance. So what we're saying is the very first decision, do I buy stocks, do I buy bonds, do I buy real estate, generates 91% of my return, of the component of my return. If I add in market timing, which was the choice, that's actually what? Less than 3% of the component of my return is driven by market timing. Okay, so the most important decision you make about making money in the market is, do I buy a stock? Do I buy a bond? Do I buy international stocks? Do I buy commodities? That first decision, asset allocation. Do you hear much about that on the news? Not a very sexy conversation. No, it doesn't sell a lot of papers, but it helps you make a lot more money.